Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Axel Merk. Merk Funds, the company he founded and he sits atop of, has about $400 million under management. Axel Merk, thank you for joining us today from Palo Alto, California.
Great to be with you again, Greg.
You wrote some great stuff, and I first started talking about booking you again on the show, and I want to start with the Federal Reserve. And what you think about the Alan Greenspan, the maestro of the Federal Reserve, was speaking, and you have some analysis on the Federal Reserve. He said that the Federal Reserve's balance sheet is a tinderbox, and he's telling people to buy gold. Explain what Alan Greenspan, who is the former Fed chief, but still, I mean, you know, when he speaks, people listen.
Well, sure, and he speaks more candidly than Bernanke speaks, who just recently left the Fed. And it started out with people accusing him that he finances the binge spending in Congress. And the reaction he had is, well, you guys have it backwards. Congress sets the tone. We just pretty much do what they tell us to do. He never said the Fed is independent. And then he went on to say that, the Fed is run by culture, not by economics. And then subsequently he said, yes, the balance sheet is a box of tinder or pile of tinder that waits to be lit. Inflation will have to rise. A few days later, when he was asked about those comments, he doubled down and he said that he doesn't think we can have a Fed exit without turmoil. And the interviewer asked him, well, do you mean crisis? And he didn't want to use the word, but yes, he agreed to that. And so he basically says, we're just going along for the ride. Congress tells us what to do.
Well, I read the post you put out, and he clearly says we're going to have inflation, and got to have inflation. Eventually, it's going to rise. And he also said that in his own, Alan Greenspan way, basically that the price of gold's going to go up.
Yeah, he was specifically asked, what do you think the price of gold is going to be in a year from now? And he says, I don't make short-term forecasts. Well, what about 5 years from now? He said, it's going to be higher. How much? Measurably. So in Greenspan's talk, he just said measurably. So, of course, you can read into that whatever you want. But then he also added that you cannot have a gold standard in a welfare state. And so basically, I mean, it's up to you to interpret whether we're a welfare state or not. But obviously, we have been increasing entitlements. And so he pretty much says you can't balance your books. And he said, well, the way you fix that is if history is any guide, people print money. He wasn't specifically talking about the Fed at that stage. But, I mean, you can read into that however you like. To us, it's very obvious. I mean, you have too much debt on the consumer side. You have too much debt on the government side. Or you're going to try to debase the value of that debt.
And therefore, then, sure, if we owe you some money at Social Security or for a pension or whatever you have, sure, we'll pay you your money. A gallon of gas is $8 and a loaf of bread is $42.50. Isn't that what we're talking about here?
Well, that would be a bargain, of course, down the road. But let's also just think about where we are. I mean, this Greenspan is, of course, old history. Real interest rates, if you deduct the CPI, if that's what you believe inflation is, from interest rates, we have very negative interest rates. They are almost 2% negative. If we do have economic growth and the Fed promises to be slow, interest rates on a real basis will become more negative. If you look out 10 years, I don't think we can afford positive real interest rates. How can we afford our entitlements? We might have $1 trillion more in interest expense a year if we go back to the historic cost of financing our debt. And of course, we have the same problem in Europe. We have the same problem in Japan. And so we're going to have financial repression as far as the eye can see.
And what about the Fed coming out in the last few weeks, coming out saying, well, we've ended our QE program? A lot of folks on the internet said they're not ending your QE program. They're going to force the banks to buy, these treasuries. They can't just simply put our debt out to the market and have legitimate bids for a debt. Interest rates would rise and rise a lot. What do you say about the Fed and their, quote, ending of the QE program?
Well, it's wishful thinking. We've had this attempt of an exit a few times. Everybody, the market has a little bit of a fit. And the reason the market has a fit is that the one thing central banks have achieved is they have compressed risk premia. Risky assets don't appear risky anymore. Junk bonds don't yield anything anymore. The stock market doesn't appear risky anymore. If risk comes back to the market because the Fed wants to do an exit, risk premia have to rise. That means volatility has to rise. All else equal, it means asset prices have to plunge. Now, if we have a recovery that's based on asset price inflation, well, when asset prices drop, we have severe headwinds to the recovery. And so it's just not possible to have an exit without having a very, very severe recession. And that's not what the Fed wants.
And aren't the money managers, people like you and people managing, hundreds of millions, if not billions of dollars, isn't everybody wink, wink, nod, nod in on this? They don't believe in the growth story. Don't they realize, don't they know that they're playing, that the Fed manipulation and the Fed propping up the market, everybody is playing this, and they know they're playing a game where, hey, they're not going to let things fall. I mean, isn't that the game they're playing, that they all know there really isn't growth, and we really don't have, 5.8 unemployment, which is the latest figures that come out. They know that, don't they?
You'd be surprised in the emails I get from various research departments. It's all over the map. Some people say, oh, we have gangbuster growth. Some people have no growth at all. Ultimately, asset prices do not reflect fundamentals. Everybody's trading on technicals these days. And the one thing I'm cautious about is one day somebody's going to decide to sell and not to buy. And guess what? Everybody else is going to pile in then. Now, that a few months ago, I thought we'd definitely have a crash ahead of us. That was before the Bank of Japan decided, oh, maybe we could buy a couple $100 billion worth of stocks. And sure enough, stock prices go up yet again. But one of these days, the glass is going to be half empty and the market is going to come down on good news.
Well, what about the Japan thing? I mean, they have doubled down on the QE. They came out and said they're going to buy every bond that the Bank of Japan, that the Japan produces, that they're going to buy every bond.
Well, what the Japanese are doing is basically they're moving their assets offshore so they can destroy their currency, default on their debt, and then they have something to take back. Some central banks used to buy gold, while they buy foreign assets. They are not doing it very prudently because they announced they're going to buy hundreds of billions. They're not going to start buying until the springtime. Their population is aging, so net they will be sellers rather than buyers. So odds are that it's going to be hugely loss-making. But what they're signaling is we are moving our money abroad. We have the Bank of Japan buy up all our debt, and then we can debase the value of the debt. We can monetize the debt, and then, depending on what happens, we got some money abroad there that we can take back home. It's not going to work out smoothly, but to me, I've said before, I think the price target for the yen is infinity. The yen cannot survive this, and this just shows that Abe is doubling down when his policies are not having the desired effect, and that's playing out right now.
Well, what happens if the Japanese move all their assets, quote, and there'll be paper assets offshore, and then there's a big global crash or a crash in the U.S. stock market? What happens to those assets? Somebody's going to get a pie in the face, aren't they?
Oh, well, of course, it doesn't work. And we've had, in the 90s, we had this discussion in the U.S. whether we should invest Social Security in the stock market, and cooler heads prevailed at the time. It's a zero-sum game. You're temporarily boosting asset prices, and you're lowering future returns. But, of course, everybody needs to fund their retirement account, and so why not pile all your money into the stock market? What can possibly go wrong to invest after a couple of years of a bull market, right? I mean, that's the mindset. And whenever the yen strengthens in a crisis environment, it suggests to us that Abenomics is fading, that people are losing trust in his policies in the sense that he cannot push them through. And then the question is what he's going to do. Well, he showed what he's doing. He's doubling down. He's printing more money. He's probably not going to have the VAT, the value-added tax hike. And so he's going to try to go out full blast. And what's happening here and what's consistent throughout the world is that we have too much debt anywhere in the world, and then you have different reactions. And the Japanese are trying to do it with populist policies and spending and printing.
Could Japan start a daisy chain of defaults? Could Japan start a global meltdown? I mean, Kyle Bass has been very worried about Japan. It's been one of his number one worry spots in the world. Is that something that could happen? Could they lose control in Japan and melt down the global economy?
Well, Japan is a little bigger than Cyprus, right? And Cyprus got all of us a little jittery. So yes, we do have odds that there can be a little bit bigger of a crisis. I mean, I heard Bernanke speak a few days ago, and he said that in October 2008, when he went to Congress, everybody remembers it this week, he said he understated the potential dangers because he wanted to sound plausible, that if he were to actually tell him what he thought could happen, that people wouldn't take him seriously, would shrug him off. So he said, I'm only considering a worst-case scenario of 10 to 14 institutions fail. But in practice, he thought it could be much worse than that. And, of course, if Japan fails, that can have major ramifications. The thing is, though, we know the playbook, right? We know the playbook. They foam the markets with liquidity. Central banks can keep zombie banks alive. But sure, when the public confidence erodes, all bets are off how this is going to play out.
So why is gold and silver right now with all this money printing? I mean, now we have over in Europe that it looks like Draghi's going to print crazy amounts of money. Janet Yellen is out saying, "Oh, that's a great idea." She's the money printer of money printers. And so why in the heck is gold and silver being hammered? And then they're running out of silver eagles at the U.S. Mint. What's going on?
Well, a couple of things. First of all, I do think that some people think we're going to have this great recovery in the U.S. We do get these mixed messages as we come in. And so we have currently priced in that we have this great recovery in the U.S. The rest of the world is horrible, so the dollar is going through the roof. Ultimately, the world isn't quite as black and white. It is a bit more grayish. The other thing that happens, because we have the markets driven by technicals, what we're getting is that when the yen drops, people have computer programs set up. Oh, the yen drops, the dollar goes up, so we have to sell gold. And the next thing that's happening is that stop losses are triggered and everybody else is piling in. And the folks who want to buy these assets, well, they're standing on the sidelines because they're saying, well, hey, when these paper guys are acting like crazy, why you don't want to catch a falling knife, and they're stepping on the sideline.
Is some of it manipulation in the market ahead of this Swiss gold initiative, or the vote where Switzerland wants to put 20% gold backing behind their currency? Is that part of that, or are there dark powers there, pushing things down? A lot of people say you can't have a rising, physical market, and demand, and then a falling price. It just doesn't work out. It's just not. It's against the laws of economic laws of Mother Nature.
Yeah, well, two things. The other day we had an expiration in the gold derivatives, and the forward leasing rates were negative. So again, showing there's very tight supply. But of course, the moment you're through that maturity, then maybe you have another drop. So that might have been part of the reason in the short term. Regarding the Swiss gold vote, that's very interesting. Ultimately, you will need the cooperation of the central bank, because if they don't like it, if it does get passed, they'll come up with some derivatives or some other scheme to avoid it. Now, I actually think it's a very ingenious idea. Mark Faber has said that, unless it's 100% backing, it doesn't make any sense, and he's not going to support it publicly. But basically, the Swiss National Bank would not be allowed to ever sell gold again, and has to buy whenever the gold reserves are less than 20%, which means over time it's going to inch up and up and up and up. And so ultimately we'll probably get to 80%, 90% if it were to go through and if the Swiss National Bank cooperates. So I think it's a very nice way through the back door to try to introduce something close to a gold standard, even though it won't be one. It's going to be extremely difficult for the Swiss National Bank to keep its peg towards the euro. If they were to take it seriously, in practice, I do think they'll come up with some ways, some schemes to. I've already gotten some emails from some bankers advising the Swiss National Bank how they can avoid implementing it truthfully, because they're going to just shift some assets away from the Swiss National Bank balance sheet and say, hey, we're doing it, and they'll find some tricks around it.
So you're saying that even if it does pass, now they're not really going to hold physical metal. They're going to get derivatives. They're going to get, that kind of stuff.
They'll get the metal, but they're not going to get as much as they should, because they will offload some of the assets to special purpose entities that are going to be away from the books of the Swiss National Bank. So they'll find ways to cheat, just as policymakers have always found a way to cheat the gold standard.
Let's take a look at the end of the year in 2015. Do we end the year pretty much where we are now, just a smooth ride out? Could we have some sort of a force majeure or a non-delivery of gold or silver at COMEX or LBMA? Could we have that? Could we have some fireworks go off before the end of the year?
I don't think so. I think in the short term, people will shrug off the vote in Switzerland, because the Swiss National Bank is going to have 5 years time to get these standards, and you need the government cooperation. As far as the markets in general are concerned, a couple of weeks ago, I warned about a potential crash. That was before the Bank of Japan had come in and said, hey, we're going to gobble up hundreds of billions. With that, the risk of a crash is a little bit delayed. Having said that, we will have to look out to 2015 in the markets one of these days. The rising dollar is not good for corporate earnings. The rest of the world is not doing so well. The printing that Draghi is trying to do isn't really working either. We have increased tensions with Russia. So there are plenty of reasons why the glass could be half empty. And we're very sensitive on many prices. And the good news about gold is that it's cheap compared to everything else. So I don't see a crunch on the physical market blowing up the gold market in the short term. I do see, though, plenty of potential danger spots in the bond market and in the stock market.
Do you think that the powers that be, the U.S., will try to push the dollar down? They've got it up to pretty high, and as you said, the rest of the world is saying everything in America is expensive now to them. So are they going to try to push that down? If so, how are they going to do it?
Well, Janet Yellen is so squarely focused on the jobs market that she's going to wait until the 2 convicted felons she profiled in her first policy speech have a job. And everything else is secondary. And so the strong dollar is going to haunt her, but she's a little bit aloof. Now, it's already quite stunning that in the FOMC minutes recently they mentioned the strong dollar, but corporations haven't really complained. And the reason corporations haven't complained so much is because the bulk of the dollar strength started late in the third quarter, which means before corporate earnings were affected too much. So now they're really suffering, and they'll start complaining late in the quarter, early next year. And I think that is when Janet Yellen is going to get some attention, saying, oh, maybe we should talk down the dollar just as much as anybody else is talking down their currency.
And you think at that point, then the downward spiral for gold and silver, price-wise, will turn around and come back up?
Well, who knows when that's going to happen. I think that might happen even earlier. We see as we're speaking, the gold price is bouncing back up. Any volatility in the stock market should be supportive to gold, if for no other reason that the paper folks are shorting gold, and then when volatility goes up, they have to short, they cover their shorts. And so those technicals in the short term might be supporting the price of gold. The fundamentals will kick in early next year.
Axel Merk of Merk Funds, thank you so much for your. Oh, also, before I go off, you're going to have your a webinar coming up. I think it's November 20th. Is that right?
Yes, a November 20th webinar on the gold standard, and specifically we'll talk about the Swiss National Bank and how investors can design their own gold standard. So at our website, merkinvestments.com, merkinvestments.com, there's a link to register for the webinar, and would welcome anybody to join us.
And I'll put it on after this interview so people can, it's free of charge, correct?
Yes, of course.
Yes, I'll put it on after the interview. Axel Merk, thank you for joining us today on USA Watchdog.
My pleasure.